executive leadership, industry newsmakers, top producer insights. This is NFM TV.
Welcome into NFM TV. I'm your host, Greg Scher. Trying times in the mortgage business, things changing so rapidly. We're going deep in our playbook to bring in a foremost expert on the secondary market and the mortgage industry in general. He was on Squawk Box for 13 years. He's the CEO of MBS Highway. You know the name, you know the face. Barry Habib, welcome into NFM TV.
Well, thanks so much, Greg. It's always good to see you, and I hope everyone's doing well. These are some very unusual times. We'll get through this, but it can be difficult and trying, especially, the foremost concern is health, but also there's a lot of confusion in the market right now. So I will try to do my best to make some sense of that for you.
All right, let's start with the Fed fund rate, which was lowered to 0% on Sunday. Loan officer phones were blowing up off the hook. Real estate agents wanted to know, does this mean my borrowers can get 0%? Obviously, that's not the case. Please explain the difference.
Yeah, absolutely. Well, mortgage rates are based on mortgage-backed securities, which are very different than the Fed funds rate. So the Fed, when they control the Fed funds rate, that's predominantly for the banking system, which is very important. We could talk about that for a moment too. But first, let's understand what the Fed funds rate is. It's a rate that one bank could charge another bank to help them with some liquidity if they need it in the very short term. And that's just for one day. That can change at any time after that. It's very different than if you have a mortgage, and that mortgage could be out there for 15 years, for 20 years, for 30 years. So think about it from the perspective of if you were lending money. Well, if you're lending money and you're going to lend somebody money and the interest rate that you're committing to is just good for one day, and if anything in the market changes, you could adjust to that, well, you could be a little more flexible with that. But boy, if you're going to commit to an interest rate to somebody that's going to be good for 30 years, there are other factors that you have to contemplate, and you're going to be thinking about things very differently if that were the case. Because if you loaned out a rate at, let's say, 4%, well, if overnight rates went up, well, you can adjust that. But if you're on the hook for 30 years, imagine if rates went to 5 or 6, and now you're on the hook for that 4% for a whole 30 years. So they're very different. What I wanted to show you, Greg, was I'm going to bring in my screen here because I want to show you very quickly some history. And I think this adds a little bit of clarity when you think about it. So here we go. When you take a look at the two lines, the blue line is the Fed funds rate, and the red line are mortgage rates. Now, over time, they seem to trend a little bit similarly, but let's take a look. So when you see here, the Fed funds rate shoots up and shoots up here, what happened to mortgage rates? Well, they actually went down. And you can see here, Fed funds rate way down, mortgage rates stayed well above it and actually went up when the Fed funds rate went down. Here's another example, Fed funds rate way down. This is going back to 2002 now. What happened with mortgage rates? They stayed pretty stable. And now Fed funds rate starts going up. Mortgage rates stayed pretty stable. So as you can see, there's not really a correlation between the two that you can rely upon. And when you look at mortgage rates, even here, 10 years ago, when the Fed took rates to 0 in the past, mortgage rates hovered here. Now they gradually went down over years, not because of the Fed funds rate, but because of other factors in the economy. And when you see here, even more Fed funds rate started going up, mortgage rates actually went down when the Fed funds rate was going up. Now this line at the very tail here, that's the Fed funds rate shooting way down. But what we don't have captured just yet is the recent move over the last couple of days where mortgage rates have gone significantly higher. And there are many reasons for that, Greg. The reasons for the Fed funds rate going higher are because when you think about what has gone on, there's two really big factors from what the Fed said just recently. Number one, Steven Mnuchin, in his press conference from 2 days ago, said something that really scared the marketplace. He did not mean to scare the marketplace. What he said is, listen, we need a package of aid to help small businesses, to help people. And trying to make his point, he said, because if we don't, the unemployment rate will hit 20%. Now, I want to put it in context for you. The Great Recession that was all so terrible in 2007, 8, and 9, that terrible recession, we saw unemployment get to 10%. So 20% would be unbelievable. That's depression-like numbers where during the Great Depression, you had close to, but not quite, 25% unemployment.
Yep.
Now, Greg, this created a whole other fear in the marketplace, because now where you have the ability to say, well, I know there'll be some delinquencies, some foreclosures, but things look to be pretty good. Should we have 20% unemployment? Well, then mortgages become a whole riskier item because of possible delinquencies and possible foreclosures. So with anything, the riskier an investment is, the more compensation you need to take on that risk, meaning rates had to go up. Now, there's another reason for this as well. This aid package was so huge in nature, in talking about trillions of dollars, 1.2 trillion, now maybe more. And in addition to that, there could be more if this thing lasts, because if people are out of work for an extended period of time, it's nice to give everybody $1,000. But if you're listening, how long would $1,000 last you if no money's coming in the door? Okay, maybe it buys you a little bit of time, but certainly there would be demands. And because of that, what's happening here is you have the government giving this money out. The government doesn't have a reserve of cash. They have to, in essence, borrow it and go into debt. How do they do that? By selling treasuries. Now, as we learn in economics, anytime where you have more supply than there is demand on the market, what happens is that prices drop. So when prices on bonds drop, the corresponding interest rate goes up to incent people to come on in. And when you see treasuries going up in yield, what follows that is mortgage rates. And that's why you've seen over the past few days such volatile disconnects. So it's got to be frustrating if you're a mortgage professional, a real estate agent, and especially a borrower, because it's very difficult to see the rapidity of these changes. They're unprecedented, but also a little bit difficult to kind of reconcile this. So when we see these things happening, there's indeed even another factor, and that is just sheer capacity. So Greg, I'm sure you know this, but there are about $11 trillion in mortgages out there. And my son Dan and I, we did a lot of extensive research on this, and we put this data out there where we showed there's about, believe it or not, $5 trillion in mortgages that could be eligible to be refinanced, save people money. And more important than saving money, if you're going to refinance, do it smart. You could pull cash out, pay off your debts, accelerate the payments, take a longer term. This is how you build a sound future for yourself and your family. So that's another discussion. But what happens is that if you take a look at $5 trillion that could be put through the system, in a great year in the mortgage industry, we might do $2.5 trillion in an outstanding year. Half of those are purchases. So you're talking about $1.5 or $2 trillion in a year of refinances. How in the world could you fit $5 trillion in a month or two? It just can't be done. So again, think about economics 101, supply and demand, overwhelming flood of business that you just can't handle. The only way to slow it down, other than saying, hey, I can't take any more business, is to adjust pricing. It's not gouging. It's not gouging at all. It's just trying to slow things down because it overwhelms the system. And this is something that you see everywhere. And over time, things should settle out. And over time, things will be okay. But for right now, these are unusual times.
Loan officers, real estate agents, we're an impatient bunch. So if you could look into your crystal ball, when you say over time, is this a knee-jerk thing that's going to last a couple of days? Could it last weeks, months? This volatility that we're seeing, how long is it going to linger?
So it's a very, very smart question, a very good question. And you've also hit the nail on the head of what people are worried about. So it is not going to be a short-term thing. This volatility will stay with us. And, today we're having a good day in the markets after the Fed's talked about the fact that it appears that the Treasury and the Fed has now come up with a package that they could do to help people and to help businesses. But, the crux of this is this virus. Now, today at 3 o'clock, I'm doing a Facebook Live with Dr. Mike Roizen, head of the Cleveland Clinic, to talk about that and then break down what it means economically. But the problem that we have is we're not 100% sure, certainly, how long is this virus going to last and what are the implications. What we're hearing is that April, it peaks. Now, peak doesn't mean it's over. Peak means that's the worst that it gets, and then it starts to get better gradually. But that means like you could be in May or June, and it kind of feels like it is today. Well, think about all these transactions that we're trying to do, and people are working from home where you're never as productive. and you think about the environment and the economy and the real slowdown that we're seeing here, we're already in a recession right now. So because of this, you don't just bounce back out of it in a few days. This is going to take some time to sort out. Now, the good news is this. Longer term, will the stock market recover? Yes. Will interest rates settle down to a good level, a really attractive level? Maybe not quite the lowest ticks that we had seen, but should we be in a place where rates are very good, giving people a great opportunity? Absolutely. But it's going to take some time to settle out to see the impact on the economy, the impact on unemployment. And what we want to find out is, most importantly, is how long till we start getting back to some sort of normalcy. It is my humble opinion that that doesn't start to happen until maybe end of summer at the earliest. Because, Greg, we're just going to be jumping back in and hugging people and going back to, people will still be getting sick. The numbers will be getting worse. Want to try and do this social distancing, be responsible. And as we do, and things start to calm down, it won't be an immediate rebound, but it will rebound. And boy, when there's a vaccination next year, then you can eradicate this bad thing. So long-term opportunity, phenomenal. Short-term, we've got to just be patient, be kind to each other, do the best that we can to get through it, but we will get through it.
I appreciate all those sentiments. Mortgage companies and real estate companies were just feeling incredible. It was gangbusters 2 weeks ago when the bond plummeted and rates went down that 1 or 2 day period. All of a sudden now the world, as we've talked about, has changed. So whereas the companies were forecasting purchases to be 80% of their volume, 90% of their volume, now suddenly we're in a world where people may not want to go into houses to appraise homes. We're already getting some rumblings on the street that some appraisers don't want to go out. And we've got title companies that aren't that comfortable. I mean, that all the links in the chain go on and on. So with that in mind, how do you see that mix changing? Do you think purchases are just going to dry up completely?
Another great question. And you're right. Purchases have to slow down. They have to, because all of the things you said, and then how about customers themselves? Do I want to go visit a home that potentially could be infected? If I'm selling a home, do I want people traipsing through that could potentially be infected? So this will slow things down for a couple of months here, at least, where you will not see the activity that we're accustomed to. So what does this mean? You look at fundamentals. The simple fundamental that exists is there are too many buyers and not enough properties. This respite that will take place in a very odd way could actually be an opportunity, because if you do brave the elements, if you do put a transaction together, you're not going to be outbid like you have been for the past 6 months. You're not going to be looking at less opportunities out there. So I'm not suggesting that people do this or don't do this. Everybody has their own tolerance levels. But what I am saying is that this will pass. And then when it does, we go back to the fundamentals. And the fundamentals were too many buyers, not enough inventory. That's where we are right now. That's where we will be in a few months from now. And that means the housing market will recover and will be very, very healthy, as long as we don't get a sustained and prolonged very high rate of unemployment. But the government's trying to do what we can. The economy will rebound. So if your mindset is, do I want to trade something quickly? Well, real estate, probably not the place to be. Do I want to take a look at, will my home value hold up in 2 years from now, 3 years from now? Will I look back and say, wow, the values in 2 years from now will be a lot higher than they are today? Yes, they will.
What about lenders, Barry, out there? We're seeing some banks halt locks, where there's some concern looking at some of the smaller players. Stock prices plummet and plunge. Do you think that there's going to be some carnage left behind on the lender side? What do you think it's going to look like?
Well, it's very hard to predict, but I will tell you this. You said that lenders were feeling good when originations were so plentiful. On the origination side, as you know, they were. But I think what originators need to know, I think what real estate agents need to know, and what consumers need to understand, is that it's not all fun. Because when a company in the mortgage process is a large company, what they often do is they service transactions. So what does servicing mean? I know you know, but just explain to everyone. It means that you're acting, so to speak, like a superintendent in an apartment building. So therefore, what you're doing is you don't own the asset, because nobody holds the mortgage. That's all sold off into the secondary market and eventually purchased by all of us on this call. If you look in your mutual funds, your IRAs, your 401ks, We're the ones that take the risk on this risky asset as it goes through the system. But everybody takes a piece along the way. And what a servicer's job to do is collect the payments, pay your taxes, pay your insurance, send you a nasty note if you're late, answer your questions, tell you what the balance is. That's what they service the loan. Now, the value of that servicing has been reduced. Why? Because the way it works is, let's just use some round numbers and say the value of servicing is 1%. That's what it would be worth. Well, you get a fee for that servicing. So you buy the servicing, you pay 1%. Now I have servicing ability. But what I collect is let's call it 0.3, 0.4 of 1% on that loan, which means it'll take me about 2.5 to 3 years of collecting payments before I've recovered my investment. It's kind of like if you're a customer and you say, hey, I want a lower rate, so I want to pay 3 points and bring my rate down. Well, that sounds good, but your upfront investment, it takes a few years, 3 years, 4 years, for the savings every month to recover your investment and then pay off in the long run. It's the same thing with servicing. Most of the time that servicing lasts for 7 years, 6 years, 8 years, whatever it is. So it's a very good business. But with everybody having refinanced, those loans are paying off very quickly. So the upfront investment is not being recouped, and therefore there's a lot of losses. Now that has a cascading effect on it. And if you think about the way our locking system works, our locking system costs a lot of money too, because what you do is when you lock a loan, it's not like somebody magically locks it in outer space. All that is a promise from a company to a borrower to say, I will promise to deliver this loan at such and such a rate. Until that loan's closed, they can't do that. So they don't want to gamble. And what they do is essentially they do something which is kind of like buying insurance. It buys insurance to say, if rates get worse, the insurance policy will go up in value enough so that I can buy enough of that rate down to the rate I promised you. And that works nice. But even if rates go down like they did, and this was dangerous, when rates go down so fast, that insurance policy now has a negative value. And while you might say, oh, okay, so it's a negative value there, but I'm getting more gain, I have a positive value on the value of the loan, the insurance company essentially says, sorry, we know that on paper it's good, but we need our money first. So there's a timing or a handshake issue which causes cash constraints for many lenders, banks, mortgage companies out there in the interim. And this is why we have such a volatile level of disruption. So this is a time for us to be understanding. Nobody's trying to gouge. Nobody's trying to do, people are just trying to find out what's going on here and survive. So we all need to have a little grace here and get through this period.
I love that explanation. Thank you. And also people need to understand that it's not the individual correspondent lenders that are setting the rate. Because of the things that you just described, a big runoff in servicing and the volatility in the market, lack of appetite for loans, they are giving lenders higher rates that then they need to push out to the market. So there's definitely, like you said, a cascading effect. Just in our last moment or two, Barry, anything else you want to touch on? And then also, I'd love to know how people can follow you.
Yeah, we do through MBS Highway, and our subscribers have been very happy. I don't know if you watch me on CNBC or Fox, but I am sorry to say, I am very sorry to say that we accurately forecasted all this. We forecasted a recession before this. When you could pull up the clip on Fox, when the S&P was at 3,200, I said, look, if it closes below, my exact words, if it closes below 3019 on the S&P, I said, look out below. The number I put out there a while ago for everybody, when the S&P was at 3,200, I said 2350 on the S&P. Everybody thought I was nuts. We hit 2350 yesterday. And now my number on the S&P is like 1810. I think that it's very possible that we get there. I'm sorry to give such a bearish forecast, but I was the only one that forecasted that interest rate. You know this, Greg. I put this all out there last year saying that rates before Corona, when people thought Corona was a beer, that it would hit 1.37. It did. When the coronavirus came, I said it's going to 1. It did. On Fox, you could see they gave me accolades, said where to now? I said it's going to a half. It did. And where we see rates right now is trying to find their ground. But I will tell you that I believe that interest rates, after this settles out, will begin their trend a little bit lower. I don't know if we get to those low levels that we'd seen, but I think they will. And Greg, I want to show you one more thing on my screen here,
Sure.
just so you could see the level of volatility. Now, This is mortgage-backed securities, and each intraday level is the craziness that you're seeing. These are unbelievable swings. This is normal. Mortgage market normal moves. This is a big move. You see this here? This is a big intraday move up and down. Big move, big move. This is a gigantic move here, but look at how it's dwarfed by the activity that we've seen of late. The market is truly in a crazy state of turmoil. And as prices go up, usually rates go down. If you want to look at rates, let's look at the 10-year Treasury. The 10-year Treasury will give you a proxy. As you can see, we were doing good. Rates were coming down, down, down. But now look at what rates have done in the last week or so. They have skyrocketed higher from a low of 0.4 to essentially tripling to 1.2. So yields on the 10-year Treasury have tripled higher. And this is where we are now. We're just trying to find some stability. When we take a look at the stock market, because I know many of you are worried about your holdings. Let me just kind of put this in perspective for you, okay? So I want to pull up a little longer time frame just to give you perspective. And when we take a look at this and we say, okay, where is the S&P going? Well, we've just begun starting to see the data. We've just begun seeing that. When the S&P was here, right here at 3,200, this is where I said we're going to 2,350. Why did I say 2,350? Because that is exactly this bottom here that you see. And when I said that on Fox, when I said that all over, look at where we hit yesterday. We actually broke a little bit underneath it. Why am I saying 18? Because that's right here is 1810. And this is where we were in the beginning of 2016. I believe that the slowdown in economic activity and the numbers you're going to start to see and the unfortunate things that are going to happen to companies, their employees, and the overall business world will probably cause the stock market to come down to this level. But I will tell you this, whether it goes below this or not, over the long haul, I think that you'll look back and think this was an amazing buying opportunity. So those are the final thoughts there. But from the heart, I wish everybody health and safety. Be good to each other at this time. You know, these are really trying times, and this is where you show your character. This is where you show what you're made of, and this is where you show loyalties. Loyalty doesn't mean in the good times I'm your friend. Loyalty means I'm there for you when times are tough. Well, they're a little tough now. They're going to get tougher, but this is the time to show what you're made of. This is the time to show grace, kindness, loyalty, and we will get through this, and there will be great opportunities ahead.
Barry, how can people follow you?
Well, if you want to, obviously on Facebook, on LinkedIn, you can just find me. You can just put me in there. But MBS Highway, really, if you're not a member of MBS Highway, I think you could have avoided all of this, because you just ask anybody, just look at our social media. Everybody is saying how we beautifully navigated this. They're probably way too kind to me, but they are. If you'd like to, there are more turbulent times ahead. And listen, the old saying, the best time to plant a tree was 20 years ago. The second best time is today. So please don't miss the opportunity. Get on board with us and know what's going on, know how to navigate, and know how to guide others through it.
All right, Barry Habib, CEO of MBS Highway. We really appreciate all of this great knowledge you've dropped on us here at NFM TV. I hope we can catch back up with you here in the near future as things continue to unfold.
Anytime.
All right, take care, Barry.
Bye-bye.